Investing. What is it, and how can someone start?
Purchasing assets that appreciate in value over time and offer returns in the shape of income checks or capital gains is the practice of investing. In a broader sense, investment can also mean devoting time or resources to bettering your own or others' lives. But in the world of finance, investing refers to the act of buying stocks, real estate, and other things of value with the intention of making money or capital gains.
How do investments operate? Investing works in the most basic sense when you acquire an asset at a low price and sell it at a higher price. A capital gain is a type of return on investment. One strategy to make money investing is to earn returns by selling assets for a profit, or achieving capital gains. The term, appreciation, refers to the increase in value of an investment between the time it is purchased and sold. A corporation can improve the value of a share of stock by developing a popular new product that boosts sales, boosts revenues, and increases the stock's worth on the market. When a corporate bond pays 5% yearly interest, and the same business issues new bonds that only pay 4% interest, the value of your bond may increase. When the US dollar depreciates, demand for a commodity like gold may increase, causing its price to rise. If you updated the property, or the neighborhood grew more appealing to young families with children, a home or condo's value may have increased. When you purchase and hold assets that produce income, investment works in addition to rewards from capital gains and appreciation. The objective of income investing is to purchase assets that produce cash flow over time, and keep onto them without selling, as opposed to making capital gains by selling an asset. For instance, many equities pay dividends. Dividend investors hang on to their investments and benefit from the dividend income rather than buying and selling them.
What are the basic types of investments? Stocks, bonds, commodities, and real estate are the four basic asset types that consumers might invest in with the aim of seeing their money grow. There are funds like mutual funds and exchange-traded funds, ETFs, that purchase various combinations of these basic securities in addition to these more complex ones. By purchasing these funds, you can invest tens of thousands of different assets. Companies raise money by selling stock to finance their activities. Purchasing stock entitles you to a portion of a company's assets and enables you partake in its profits and the losses. Some equities also distribute dividends, which are sporadic small payments made from earnings. Stocks have a higher risk than some other investments because there are no guarantees of profits and certain companies may fail. By purchasing bonds, investors might become the bank. When businesses and nations need to acquire funds, they issue bonds, which are forms of debt that investors can buy. When you buy bonds, you are giving the issuer a fixed-term loan of money. The issuer will repay your loan to you along with the money you initially advanced to them, plus a specified rate of return. Bonds are also referred to as fixed-income investments due to their guaranteed, fixed rates of return and are typically less risky than equities. However, not all bonds are safe investments. Some corporations that issue bonds have a bad credit history, which suggests that they may be more prone to miss their repayment obligations. Agriculture items, energy products, and metals, particularly precious metals, are all considered commodities. These assets, whose prices are based on market demand, are typically the raw materials needed by industry. For instance, if a flood reduces the amount of wheat available, the price of wheat may rise as a result of scarcity. Purchasing physical goods entails acquiring large quantities of gold, wheat, and oil. This is not how most individuals invest in commodities, as you might assume. Investors instead use futures and options contracts to purchase commodities. Other securities, such as ETFs or purchasing the stock of firms that manufacture commodities, can also be used to invest in commodities. Investments in commodities might be comparatively risky. Trading in futures and options typically entails using borrowed funds, which increases your risk of losing money. Because of this, purchasing commodities is normally reserved for more seasoned investors. Purchasing a house, a building, or a plot of land can allow you to invest in real estate. Real estate investments come with varying levels of risk and are influenced by a wide range of variables, including local government stability, crime rates, economic cycles, and crime rates. Consider purchasing shares of a real estate investment trust if you want to invest in real estate without physically owning or managing any property, REIT. Companies known as REITs use real estate to produce income for its owners. They typically yield bigger dividends than many other types of assets, such as equities.
Mutual funds and ETFs. Different investments carry varying degrees of risk. Taking on more risk means your investment returns will grow faster, but you will also have a higher possibility of losing money. In contrast, lower risk means that you will generate earnings more slowly, but your investment will be safer. Gauging your risk tolerance is the process of determining how much risk to take on when investing. You presumably have a higher risk tolerance if you are willing to accept more short-term ups and downs in your investment value in exchange for the possibility of larger long-term profits. On the other side, a slower, more reasonable rate of return with fewer ups and downs may make you feel better. In that instance, your risk tolerance may be reduced. Financial experts advise taking on more risk when investing for a long-term purpose, such as when young individuals invest for retirement. When you have years or decades before you need your money, you are often in a better position to recover from drops in investment value. While the S&P 500 has had a few short-term lows, including recessions and depressions, it has nonetheless generated average annual returns of around 10% over the last 100 years. However, if you had required your money during one of those dips, you could have suffered losses. That is why, when investing, you must consider your timeline as well as your total financial status.
How can I start investing? It's not very difficult to begin investing, and you don't need a lot of money either. How to choose the best type of starter investment account for you is explained here. You might begin investing with a robo-advisor if you have a little sum of money to open an account but don't want the responsibility of selecting investments yourself. These are computerized investment systems that enable you to put your money into diverse, pre-made portfolios that are tailored to your risk appetite and financial objectives. Open an online brokerage account and choose your own investments if you prefer doing in-person research and selection of your investments. Keep in mind the simple diversification that mutual funds and ETFs provide if you're a beginner. Speak with a financial advisor who deals with beginning investors if you prefer a hands-off approach to investing and further expert guidance. You can develop a relationship with a dependable expert who is aware of your objectives and who can assist you in selecting and managing your investments over time by working with a financial advisor.
No matter how you decide to begin investing, remember that it is a long-term process, and you'll profit most from making regular investments over time. That entails following through on an investing plan whether the markets are rising or falling.